Hello and welcome to another weekly financial update from RTS Financial Planning. As always, this is where we go through some of the stories that have happened in the world of finance this week and also discuss some of the subjects that our investment committee are looking at as part of our investment strategy. If you want to know more about the RTS investment strategy, just get in touch and we'll be happy to share details with you. Before we start, it's actually Financial Planning Week this week, so now's a better time than any to be looking at your finances. And many financial advisors up and down the country are running various events and things to celebrate the week. We actually share the week with National Space Week and National Curry Week, so I'll let you decide which is the most interesting. So as far as stock markets are concerned, it's a fairly quiet week for stock markets this week after initially some fears that took place after it was announced that Donald Trump had tested positive for coronavirus. So the US market in particular got a little bit spooked, went down for a little while as there were sort of nerves around whether there would be uncertainty as to how he would recover and then what would happen to markets and government going forward. But they pretty much bounced back and Donald Trump seems to be okay. He seems to be keen to get back to fighting his election campaign. And he's also had time to put a block on the latest US stimulus package. So this has let down investors and the markets went down slightly on this news as they're desperate for some further cash injections into the US economy. But Trump has now said that nothing's going to take place until after the election. So we'll have to wait and see what happens next. There was some tough news for the US's biggest tech companies this week as the US government concluded its 16-month-long investigation and concluded that the tech companies are actually too big and have too much power over society. So they do recommend breaking these tech companies up into lots of smaller companies. So for example, the likes of Facebook would have to break up into Facebook and Instagram separately. Google would have to separate from YouTube. Now it's interesting to see how far the US government are going to go with this, and it could be good and bad news for investors. Bad news on the one hand is obviously lots of uncertainty will hit the stock price and could send the shares of these companies down. And obviously they've done very well over the last few months and have hit record highs. Some would say that these tech stocks are actually overvalued now. So yeah, bad news could come in the form of uncertainty, which could lead to a fall in share prices. But also when you get super large companies like the tech companies have got, they have lots of individual parts and investors will value the company as a whole and sometimes miss the value that individual parts of the companies bring. So if they are in fact broken up, you could find that the individual companies themselves are more highly valued than the larger sum of all parts. So it'll be interesting to see what happens next. Now, I'm not sure whether the US government will want to go as far as tampering with these tech companies too much, particularly with the competition coming from China. China now have their own versions of these big tech companies, the likes of WhatsApp, Google, Amazon. They have their own versions of these companies now in Alibaba, WeChat, Huawei. So I think the US government will want to be careful about tampering with the competition too much. In the UK, we found out that one of the largest cinema chains, Cineworld, would be closing all of its cinemas until further notice. This was due to a lack of big movie releases. Its share price fell 40% on this news and has been falling further since. Can the company survive? Well, during the first half of last year, it made around 92 million. But the first half of this year, it's actually lost 1.2 billion as COVID has had a massive effect on its ability to trade and run. And this just goes to show again that holding individual stocks can be very dangerous in your portfolio. It's much better to diversify across sectors and in individual companies. You never know what's around the corner and what could come along and actually hit and smash individual companies and sectors. I mean, who would have thought at the start of the year what could go wrong for a company like Cineworld? It's a large FTSE 250 company with around a 20% market share of the cinema. So yeah, you would think that's a fairly safe bet. But like I say, there's always something that can come around the corner and affect individual companies. We've seen it before, the likes of BP, the oil crash spill, Tesco, the accounting scandal. These are large companies that have been severely impacted by one-off events. It's much better to hold a range of companies and sectors through a fund. For example, if you look at the Cineworld share price versus the FTSE 250 in its entirety, you'll see that the FTSE 250 is far less volatile in its entirety and has performed much better than Cineworld on its own. And finally, the UK state pension age is now changed to 66, meaning this is now the earliest age at which you can get your state pension, which is currently £175 per week. Now, the UK state pension age has been rising gradually. It was previously 60 for women and 65 for men, but over recent years the government have equalised these ages and have been raising them. The state pension is expected to increase again to age 67 between the years 2026 and 2028, and again to age 68 between the years 2037 and 2039. So this now means that more than ever, it's essential that you fund your own retirement for an appropriate savings and investment strategy. So that wraps up this week's update. I hope you found it useful. As always, please leave a comment and please subscribe to the channel, as we're producing regular videos on a range of retirement and pension scenarios. Until next time, take care.